Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our Q&A series, I will be addressing questions about the infinite banking concept, becoming your own banker, and I hope that you enjoy. The first question is about loan repayments. Can these be automated and how do I do that? So this can be a simple call into your company, get on the phone with customer service. Again, I have a very hands-off approach. While I'm a big believer in service, I have ongoing conversations with my clients. My clients get carte blanche with me. They get open access. We text, we voice memo, we call. We can have regular conversations, consultations, of course, but I'm always seeking to empower as much as possible. So when you've taken a policy loan, if it would be helpful to you to automate your policy loan repayment, it's as simple as you can get on the phone or use a portal in some situations. Get on the phone with customer service and just set that up. If you've already got an electronic fund transfer established and you're paying premiums from some designated savings or checking account, then you can also establish, okay, on this day of the month, I want this amount to be paid back to my loans that I have outstanding currently. So great question, love that. Of course, the opposite is also true, which is, well, you could just be making lump payments back to an outstanding policy loan balance when it's convenient for you. Again, online, depending on your company, and then just by making a phone call to customer service as well. The next question is, can I use my policy as an emergency fund? Now, this one actually came up in conversation. I was having an annual client consultation call, and that's just more proof that the more that you continue down this journey, the more that you can see is possible. This client had used her policy so far for some travel, and then also for some emergency situations that popped up at the end of that first year of owning and using the policy. And she didn't realize that she had used it as an emergency fund. But I pointed it out in that consultation call saying, well, did you realize that, yes, you've used your policy for this travel, really into travel, enjoys travel, had done some travel with family, but then needed to access capital and was able to do so when a family emergency popped up. But I needed to point that out. Hey, did you realize that you use that as an emergency fund? And I point this out because she had other funds staged elsewhere for emergency funds as well. And we just were able to use that scenario to talk about the difference between having 15-minute money that you could get access to because it's cash handy, or it's money in a checking account or savings account where you could drive into town, take out from the ATM or the bank some funds that you might need for a 15-minute emergency, right? But then there are other funds that should be considered staged in a more appropriate place with more benefits, okay? But that you wouldn't need necessarily in 15 minutes. But if you could get it in a few to several business days, okay? So your 3-month emergency fund, your 6 months worth of living expenses type emergency fund, or whatever amount that you deem is appropriate for you to have an emergency fund, does it all need to be 15-minute money? Probably not. If you're building up a year's emergency fund, does that need to be money under the mattress or just sitting in a checking account or a savings account? Possibly not. And what are the advantages of having emergency funds that typically would be in, say, a high yield savings account or a money market account or some other such place? What are those benefits? Well, remember, every additional dollar that we pay in premium is creating a death benefit that grows, a cash value that grows compoundedly, and it's creating a bigger dividend that we are eligible for. Okay, so every dollar in premium that we're paying extra, so let's say I decide to stage my emergency fund in a policy or in a system of policies that I own and control, and I do, then I'm making my death benefit bigger than it otherwise would have been. My cash value is growing, otherwise bigger than it would have been. And I stand to earn a bigger dividend than I otherwise would have. And I can still take a policy loan from this family banking system of policies that I own and control and use in the event of an emergency. So it's worthwhile to have your 15-minute money for sure. But the longer staged emergency fund, I would say consider putting that in your policy. And then also, just more importantly, recognizing the flexibility of this ideal asset. See, folks have used historically whole life insurance when they've come to a position where, well, maybe they couldn't qualify for a traditional bank loan, conventional bank loan. Okay, and so just think of your Miss Christophers, your Walt Disneys, your Ray Krocs, folks who we've heard, J.C. Penney, weathering the storms of the Great Depression. Okay, folks have used whole life insurance before to weather storms or to take advantage of opportunities. And life does give all of us these two things: opportunities and obstacles. So on this theme of emergency fund, just see what's possible. It's possible for us to stage what would typically be emergency funds in a policy and have that benefit us for our whole life, puns always intended there, and those coming up behind us. So that was a great conversation that I had with a current client, and I hope that you found it helpful as well. Here I was asked a question about what are the 5 biggest pros and cons to a 40-60 split versus a 10-90 split on a whole life policy with one of the 4 major mutuals if your main goal is IBC. There's so much here. Let's start with the last part of the 4 majors, meaning major life insurance companies, mutual life insurance companies. So I personally have more than one policy from more than one company. Let me say that first and foremost. I have policies from multiple companies. So you should be familiar with your company. You should be familiar with your contract from that company. And if you're vetting this concept, you should be familiar with, I would suggest, who embraces the infinite banking concept. Okay, so for folks that are looking to actually implement the infinite banking concept, you're not just trying to acquire a great asset from a great company, a big company, a profitable company. If you're not just trying to acquire an asset, set it on a shelf, but if you're looking to implement this idea of becoming your own banker, as codified by R. Nelson Nash, then why not ask the question, who amongst mutual life insurance companies embraces the infinite banking concept, embraces the Nelson Nash Institute and this idea of becoming your own banker? It's a good thing to know. I own companies that embrace the idea of the infinite banking concept. I think that's a great place to start. Now, being familiar with the companies is great. They all have the bases covered of their mutual life insurance companies. They have a strong dividend record of consistently, consecutively paying at least 100 years straight dividends to policy holders. So they're all old companies, profitable companies. And if they're embracing the infinite banking concept, great. I decidedly do not speak of insurance companies in my material, while still just being open to say I own policies from mutual companies, and I own many policies, and I will continue to buy more policies from more companies over the course of my life, and will teach my children and grandchildren to do the same. And much more important than the company, while it's still worthwhile to look at the company and then the contract, is how you plan on using it. So let's get to this other part of the question where we're talking about pros and cons to splits. Now, I've covered policy splits in my encyclopedia series just to introduce you to that concept. If you need that, that can be done in the show notes below to be helpful. But it deserves a more robust answer to evaluate case design for you. There's so much that needs to go into this. Actually, in fact, you can see a big part of how I approach this question for the individual by having a holistic, comprehensive look at what I call your financial footprint. So on my website, durhamtalents.com, scroll down to the bottom, and there is a PDF there that you can access for yourself. It's what I use in my client consultation calls. This is something that we update regularly each year because your numbers change, your financial footprint changes, grows, develops, etc. But there's just so much more to this than, okay, give me these 5 bullet points, give me those 5 bullet points, let me make this decision. There are times where more base will make sense for someone based on multiple reasons. I'm addressing the question, but I'm not as well. I know that some are going to feel like I'm sidestepping. I'm not. There's just too much to cover here. I'm going to have a lot of questions of, well, have you read the book? Do you understand this concept? Okay, if you understand this concept and you've embraced this concept of, well, I want to become my own banker, your ability to pay premium over your lifetime comes into question. Well, the only premium that you have an opportunity to pay, and an obligation, there's an obligation there when you're talking about base premiums, can be for your whole lifetime. And I, in fact, want to be able to pay premiums for my whole lifetime. Now, does that mean that it always has to come out of my pocket, out of my cash flow? No. You could be so creative. It's the infinite banking concept. And the policies are so efficient, of course, that they can get to a point of taking care of their own ongoing policy premiums. I've addressed this topic in so many areas. The Roundtable series, if you've not seen our Roundtable series, that's a great place to start. The Myths, Mysteries, and Misconceptions playlist that I have, where I'm talking about our whole life insurance premiums, high premiums. What if I don't want to pay high premiums later in life in my retirement or passive income stage of life, and these types of things? But at a very foundational level, if I've embraced the infinite banking concept and I want to be able to pay premiums for my lifetime, and if I expect my cash flows to increase over my lifetime, and I'm going to want my children and grandchildren to have a place to be able to warehouse an increasing cash flow and future windfalls from the policies that we have created, then don't I want to be able to pay significant premiums for as long as possible, as often as possible, as much as possible, in an increasingly growing fashion as possible? Does that make sense? So there's so much that goes into this. Policy design is not just policy splits. Are there advantages of 40/60 versus 10/90? Absolutely. Do I own 10/90 policies? No. I want a robust base foundation on all of my policies. And does that number change depending on the situation? Yes, it does. So all that to say a lot, and yet maybe not enough, but suffice it to say, from me, since I was asked this question, work with somebody who has implemented the infinite banking concept in their personal life. I think it best if you're working with an authorized infinite banking concept practitioner, which I am. But again, more importantly, someone who's implemented the concept in their life. I've done infinite banking. I'm in my 11th year of doing so. And I have significant base policies. So do my children. So that's not giving you 5 and 5, but that's my answer for now. Keep learning about this concept. Let me add that the smaller a percentage of your total premium that goes to the base, all right? So the more thin, the more feeble, the smaller, the more insignificant as a percentage your base premium is in comparison to PUA premium that you're trying to put in, the more feeble, small the policy will be. A stronger base has more MEC resilience. A stronger base generally yields and leads to greater dividends. And the way these contracts work, especially with the more flexible paid-up addition riders offered by companies, the greater amount of base premium that you pay allows for multiples of itself to be paid in paid-up additions premium as well. Meaning if there is an opportunity for you to be able to pay, let's say, up to 3 times the base premium in paid-up additional rider premium, PUA rider premium, then the smaller your base, the smaller PUA you can pay. So base is the engine of the policy. The base is the foundation. There is no paid up additions rider without the base policy contract. So there are many reasons of why you would want a strong base policy, both here in the short term now, because again, if I can pay this amount of base premium and the insurance company will let me pay multiples of that amount in the paid up additions rider, well, if this number is bigger and more appropriate for me, for my cash flow, then that means that my opportunity is that much greater. And then of course, long range, because of the effect on dividends and how you can supplement passive income later in life, there's just such a strong case for more resilient policies that have a significant base. So is something typical like a 40-60 a type of split that I own in policies? Yes, it is. Are 1090s? No. But does that mean that 40-60 is the way to do an infinite banking policy? No, that's not the case either. It should be based on the individual, you and your conversation, your cash flow, your goals, your plans, your priorities that are discussed between you and your financial professional. Let's address some more premium questions here. I got a question, is the premium going to change? So do whole life premiums change? So no, they don't change. Whole life insurance is a level premium policy. Now, there's variation in the types of whole life insurance that you could have. There's 10 pay, there's 20 pay. So in those examples, you're going to pay a level premium. The premium's not going to change for those 10 years, for those 20 years. There are policies that are whole life 121, meaning base premiums are going to be paid on that policy to age 121. And that premium's not going to change as far as the base premium goes. That's a requisite. A whole life policy is a unilateral contract where your obligation as the policy owner, your sole obligation is to pay the base premiums. And then of course any rider premiums that are necessary to keep riders in force that you want to have, those have their minimums as well. The flexibility comes in with the paid up additions rider. So when you have an IBC style policy, the flexibility is in the paid up additions rider. So can that change based on your goals and plans, your cash flows, and the terms of your contract? Yes. Yes, there's a lot of flexibility there, and thank goodness. And that's very helpful, of course, for a banking style policy. But do base premiums change? No. Now, does that mean they always have to come out of pocket? No. You could do premium offset, surrender, paid up addition. There are lots of options. I have a lot of options listed in my non-forfeiture options video from my encyclopedia series. I would encourage you to check that particular video out for enumerating and giving details on those options. But premiums stay level with whole life insurance. And then I got a subsequent question on this particular call of, wouldn't the whole life portion, meaning of the total premium paid, the whole life meaning base, be more expensive? See, that's a very interesting question for a couple of reasons. A premium dollar that's paid to base buys you more death benefit than a paid up additions rider premium dollar. Okay, so out of the total premium paid, when you're paying premiums for riders, you're getting what those riders entail based on that premium. The base premium buys a lot of death benefit respective of the premium dollars paid, more so than dollars that go towards the paid up additions rider. And yet the paid up additions rider, for those seeking to implement the infinite banking concept, is where you achieve, where you acquire that early cash value of your policy. So the dollars that are paid in premium that go to the paid up additions rider create that early liquidity that you can leverage, that early value that you can leverage in a liquid way, having policy loans right away with a policy. So it just depends on what you mean by expensive. And then of course, over the course of time, here's where I need to say that over the course of time, while the paid up additions rider may have its limits on how long you can pay premiums, the relation of premium to cash value created does not compound in the way that premiums paid towards the base premium of the policy compound. Meaning, If I pay $100 in paid up additional premiums, that's going to create virtually 90+% cash value that's leverageable virtually immediately within 30 days or less. Premiums paid in the beginning of a policy towards base premiums do not create that 90+% liquidity. It's much less. There's no loss of value, but there's loss of early liquidity. But as that policy matures and I continue paying that $100, you get to the point to where $100 of base premiums paid creates more than $100 worth of cash value that's leverageable via policy loans. So I can be have the input of $100 and have more than $100 available to me because of the compound growth of this policy. So is the whole life portion more expensive in this policy contract? There's a lot that goes into addressing that. Not just answering that question, but addressing what's being asked there or not being asked. And I hope that that's been helpful. The next question about premium comes from a Windfall. So the question is, there's a secondary home that's going to be sold. Should I take the profits from the sale of that house to pay off my portion of a plane that I'm acquiring, or pay that as additional premium into the policy and then pay off with a policy loan my portion of this plane that I am procuring? Well, of course, that's a question for the individual to really answer, but to address it, I want to do here for the benefit of everyone, whether it's a plane or whether it's a car, or whether it's anything else. If you have a windfall coming, wealth must reside somewhere, capital must reside somewhere. You're going to send your money somewhere. So anytime that I can put additional cash flow towards my system of policies by either paying regular scheduled premiums, additional paid up premiums, which is what the question was here, or even creating a new policy, or paying off policy loans, or at least outstanding policy loan interest, all those are viable options for sure. But I highly prioritize paying additional paid up premiums into policies that I already own. I want to maximize the cash flow to my system of policies as often as possible, as much as possible. So with a windfall, that wealth must reside somewhere. It must go based somewhere. It must be warehoused somewhere. It must be banked somewhere. Okay, so again, here, great visual analogy, I hope, and reminder. A food bank has food that comes to it and flows from it. It serves a purpose. It's a food bank. Yes, it's warehoused there, and it's also deployed from there. So, are there advantages to taking a windfall, warehousing it in a whole life policy before deploying value from that whole life policy for something that you are going to do? Well, remember this: every time that premium is paid, death benefit can increase, cash value can increase, and death benefits can increase just by adding that one step to what you already have done. So instead of just taking the cash flow from windfall and making a purchase that you're going to make anyway, what if we could have the added benefit of, well, we increased our death benefit from what it was, we increased our cash value from what it was, and now we'll receive a bigger dividend by having paid that extra premium than we otherwise would have. But then, of course, just follow that scenario out. There is something to be said about, well, yes, Jesse, but if you're taking a policy loan to go out and make a purchase on a plane, what about that windfall? Okay, so which again just brings us back to talking about, well, where did that windfall come from in the first place? What cash flow did you used to have going to that entity, that home, that secondary home, where you made the sale to then have the funds to pay additional premiums and then subsequently make this plane procurement? Should you perhaps continue making that cash flow commitment but to a new location, i.e. a policy loan repayment? Yes, that's one viable and obvious logical option. And are there others? What else do you have in your financial footprint that could help fill up that vacancy that you've created? Absolutely, that's definitely part of the conversation as well. But in general, anytime that I can have more cash flow, additional cash flow, go to my family banking system because it's going to touch a bank somewhere. Yes, I want it to go through my family banking system. The next question that I have is, how long can we, it's having a consultation call with a client, continue funding the policy this way? We were actually looking at a policy illustration, and that was the question that was asked to me. And of course, the policy illustration is just showing a snapshot of, well, what it would look like if you set it on the shelf and didn't touch it and nothing moves or changes and the dividends. So an illustration is just that. It is a picture of what it can be. Now, I know and understand and would underscore that there are guaranteed elements, which again underscores why whole life insurance is the ideal asset. There are guaranteed elements to that, but an illustration is going to change from time to time. It's going to be different. Dividends can be higher or lower, your use of the policy, etc. But I understand the question here to be, how long does it make sense for us to fund these premiums that are illustrated out of pocket? And then that just leads us to a comprehensive conversation, of course, around what is your approach to retirement or passive income time of life whenever you're deciding to make that transition. What point in time are we looking at then perhaps on this policy as we know it to be today? If we're looking 5 years into the future, 15 years into the future, 25 years in the future, that matters. But of course, the further down we get in time and on this policy illustration, do our abilities increase and do our options increase, even just with this policy, because of its compounding, because of its efficiency? Yes. And again, you're the biggest contributor to this if you are actually banking with this policy instead of just setting it on a shelf. Who knows how much more you will grow this contract over the course of time? Because the more that you bank with this policy, as described in Becoming Your Own Banker, you are directly manipulating the death benefit to increase and the cash value to increase and the dividends to be able to increase. But I'm asking this question here because, again, there's a lot of optionality that you have when it comes to owning and using whole life insurance policies. And I've already referenced my non-forfeiture options video from our Encyclopedia series. Feel free to check that out. But I've also been talking about base premiums here in this particular Q&A episode, and how I want the opportunity to be able to pay premiums for as long as possible and do that as much as possible and as frequently as possible. So how long can we continue funding the policy this way? I mean, your business, your goals, your plans, your cash flows all come into this conversation, but I'm trying to do it out loud here, share some of my perspective for everyone's benefit. If you have a further question about what's being discussed here, feel free to put that down in the comment section below and I'll address it. And then another question that was asked about premium is having multiple policies, meaning from the start, a good way to stay further away from the MEC limit? Interesting question, just because of the thinking behind, well, hey, I want to avoid the MEC. If you've not seen my Encyclopedia series video on the MEC, the Modified Endowment Contract, you can check that out below in the show notes as well. But every individual contract has its MEC limit, and that's always a moving target. Doesn't go away. 7-year rolling moving target on every whole life insurance policy. So does having multiple policies help you stay away from the MEC limit? No, because every policy has its own MEC limits. And there's a lot to be said here about proper design of a policy contract. I don't have a cookie cutter approach. I don't believe that a cookie cutter approach is beneficial. Like the earlier question about, hey, why or why not a 40-60 split? Why or why not a 10-90 split? Tell me the pros, tell me the cons. I don't have a cookie cutter approach. We talk about your goals, your plans, your priorities. We look at your financial footprint. You determine what is an appropriate amount of premium for you based on our conversation around your goals, plans, and priorities. And then we will build out a system over time, systematically taking those strategic steps as it makes sense for you. Making sure that each individual policy, yes, avoids the limitations of the Modified endowment contract when appropriate? Absolutely. On that note, there are times when a modified endowment contract, a MEC, can be exactly what you want, but for specific purposes, not in general for implementing the infinite banking concept. Yes, we're looking to avoid MEC status for banking purposes outside of legacy implications typically. But can you avoid the MEC status by having 2 policies instead of 1? The answer to that question is no. But is the ultimate idea here to create a system of policies over the course of time? Absolutely. Banks have multiple branches. We're building our own privatized version of that by building out a system of policies to help us account for more and more of our income and cash flow that we experience in life. Here's a question about insuring a minor. This question of, if my minor child were insured now, would she qualify for more insurance than when she turns 18? And this comes from a conversation where I'm discussing what it would look like to add a subsequent policy to the portfolio of a current client. So there are a few things that go into discussing policies on a minor. Could an adult child be eligible for more insurance than when they're a minor? Possibly. It's going to depend on them as an adult at that point, just like it does for all of us outside of minors, based on our age, based on our net worth, based on our income. So typically speaking, younger adults are not going to have their greatest income at that stage in life. Virtually all of us earn more over the course of our working years. So there are cases where it would be possible, based on, again, the income and the in-force insurance on the adult parents, that a child, a minor, could be insured for more than they would be by the time that they turn 18 and get their own income to show and acquire policies. But again, there are so many things that go into this, because my philosophy from the start is, we'll of course acquire protection through a whole life insurance as soon as possible. I mean, we had on our 4th child, or our most recent child, we got his policy in force before he was a month old. Okay, so before he had his first month this side of sunlight, he had a whole life insurance policy in force on him. Okay, so the protection piece is just so important, and I have this mentality always of, when I'm writing a policy contract for a client, I presume to write that policy contract in a way that if this were the only contract that client were ever able to get, I want it to be that robustly and that holistically built. So policy structure matters, and of course we're all only eligible for, at any given point in time, so much insurance. Children typically are eligible for typically half of what their parents have in force. So again, to answer this question, is it possible for a minor to get more insurance than that same minor could potentially acquire when they do turn 18 and adults? Yes, that is possible. Also, could the reverse be possible? Yes, but again, it's going to depend on how earnestly parents have applied this concept of infinite banking in their lives and how much insurance that they have acquired, because that's going to predetermine the limit for a minor child. So there are some moving parts here, and that goes to speak to your ongoing conversations with your professional. But again, I always lead with, if you can get a policy sooner, get a policy sooner. Focusing on protection is a good starting point, but like Nelson says, of course, when you implement this concept in earnest over a lifetime, you can end up with more death benefit than you otherwise could have been underwritten for, approved for from the onset. And yet, I still lean into protection first. I was 30 years old when I got my first whole life insurance policy, and then our older children were several years old. Some of the older ones were several years old, but of course now that we've been implementing this concept going on our 11th year, we got that weeks old baby his first whole life insurance policy in our household, and it acquired him the insurance that he was eligible for, and it was an IBC style policy that we could have and have used for infinite banking purposes as well. So I hope that that's been helpful about insuring minors. If you have any further questions about becoming your own banker, the infinite banking concept, whole life insurance, you can put that down in the comments section below. And to speak with me, you can find me at durhamtalents.com. And it is my hope that you live and leave a lasting legacy.